S corporations. An S Corp, also known as a sub S, refers to the type of corporation that meets specific Internal Revenue Code requirements. The requirements give a corporation with up to 100 shareholders or less the benefit of incorporating while being taxed as a partnership. The corporation may pass the income directly to the shareholders to avoid that double taxation. Welcome to this episode of Biz Coach and Coffee, where we combine business strategies and coffee. Right now we're having a series regarding business entities. We get so many questions on what kind of entity should I set up, or do I have the right business entity for my business? So let's understand S Corps. Corporation taxes that are filed under Subchapter S may pass the income, losses, deductions, and credits down to the shareholders. So the shareholders report any income, losses on their individual tax returns and pay the taxes at their ordinary tax levels. So S corporations pay tax on specific built-in gains, passive income, and at the corporate level. S corporation shareholders must be individuals, specific trusts and estates, or certain tax-exempt organizations. Partnerships, corporations, non-resident aliens do not qualify as shareholders. So specific financial institutions like insurance companies and domestic international sales companies are also ineligible. So here's some advantages of filing under a subchapter S. So registering may help establish credibility with some potential customers, employees, suppliers, investors by showing them that you're an owner of a formal commitment to the company. Also, a S Corp doesn't pay federal taxes on the entity level. Saving money on the corporate taxes is beneficial, especially when a business is established. Other advantages include the transfer interests of an S Corp without facing adverse tax consequences, complying with many of the accounting rules, don't forget that. And now shareholders can also be the company employees, earn salaries, receive corporate dividends that are tax-free if the distribution does not exceed their stock basis. Now, if the dividends exceed the shareholder stock basis, the excess is taxed as capital gains. Characteristics of distribution can be as a salary, dividends, and it also helps reduce the owner's liability for self-employment tax while also generating business expense and wages paid deductions. Characterizing distributions as salary or dividends may help the owner reduce the liability for self-employment tax while generating business expense and wage paid deductions. So here's some disadvantages of a sub-S. Because an S Corp can disguise salaries as corporate distributions to avoid paying payroll taxes, the IRS kind of they scrutinize how these S Corps pay their employees. So S Corps must pay a reasonable salary to their shareholders' employees for services rendered before distributions are made. So filing under a subchapter S also requires a little bit of time and money. Yet when entering a subchapter S, the owner submits articles of incorporation with the Secretary of State. The corporation must obtain registration agent for the business, and it pays other fees associated with incorporating itself. Now, in many states, the owner must pay an annual report fee, a franchise fee, a miscellaneous fee. However, these charges are typically inexpensive and may be deducted as a cost of doing business. So put them in your business. Also, all investors that receive a dividend and distribution rights, regardless of whether they're an investor or not, they have those voting rights. Also, all investors receive dividend and distribution rights, regardless whether they're an investor or even have voting rights. So some key takeaways. An S corporation, also known as a subchapter S, refers to the type of corporation. Requirements might give the corporation with 100 shareholders or less benefits of incorporation while being taxed as a partnership. Corporate taxes are filed under a subchapter S may pass the business income, losses, deductions, creditors down to the shareholders. So shareholders get to report those incomes and losses on their own individual returns and pay taxes at their ordinary tax rate. And S Corps must be made up of individuals, specific trusts, estates, or certain tax-exempt organizations. We hope this helps determining what kind of entity you should have. Please let us know if you have any questions regarding this episode or any other episodes, or if you have ideas for future episodes. Let us know at steve@bizcoachsteve.com. Here's to your business success. This is Biz Coach Steve Feld. Have a great day.